Welcome everybody to the industry panel presentation that we've put together for today. We appreciate everybody who's joining the Zoom presentation. We have a very large group today and we're grateful for that. We also have an excellent panel that will be talking about a variety of subjects related to the current real estate and general economic environment, what they're seeing and how that may impact you and your business and your clients. Before we begin, I need to remind everybody that this is not an offer to buy or sell security, which can only be done through a private placement memorandum. If you do have questions during the presentation, you can use the Q&A feature, type in your questions. We'll do our best to get back to you, back to those questions throughout the presentation. If we don't, we'll send them around and hopefully be able to answer them after the fact. If you do have questions after the panel, rather than everybody giving out their individual phone numbers on this presentation, I would just say you can contact us and we can disseminate any questions you have, either at 8444-SHOPOFF or via email info@shopoff.com. So to begin with, my name is Daniel Oschin. I'm the Chief Strategy Officer of Shopoff Realty Investments. I'll be moderating today. We have 4 distinguished panelists that will be doing most of the talking, hopefully. And I thought each one of them can introduce themselves briefly, just give their name, their company, and generally what they do, so all of you know who they are. And why don't we start with Chet? Why don't you introduce yourself?
Chet Payne, Arcadius Capital. I'm the president. We're an independent broker-dealer based out of Atlanta. We have a little over 200 advisors, about 50 different offices located in the United States.
Great. David?
Hello, everyone. I'm David Becker. I'm head of capital markets and strategy for Time Equities. We're a real estate investment development firm based here in Manhattan. We own properties all over the US, Canada, Europe, and we have about $7 billion in assets.
Rizwan?
Hi, everyone. My name is Rizwan Ibrahim. I focus on due diligence and strategy at Creative Wealth. We are an RIA based in San Ramon, California, and our focus is exclusively on alternative investments.
Great. And Bill?
I'm Bill Shopoff. I'm president and CEO of Shopoff Realty Investments. We're a value-add, opportunistic real estate investor, 31-year-old company, and we have a portfolio of approaching $2 billion.
Thank you. Thanks, everybody. So the goal here is to provide useful information to the group that's listening in, hopefully some takeaways they can use within their business or to communicate to those that they work with. And I'm going to start right off the bat with Rizwan. You get to be in the hot seat right off the bat. Let's start with the thing that most people are talking about today. What do you see as the current status or future expectations for inflation and recession-related concerns that come from that?
Thank you, Daniel. Well, I think inflation is sticky. I think rates are higher for longer to keep this inflation down. And it's hard to see how we will have a soft landing given the deteriorating economic conditions. So let me expand on that. If you look at the inflation target the Fed has, it's 2%. I mean, today, core PCE is 3.9%. And look at food and energy and housing. So energy and housing is not in the PCE, but they are also increasing. So when you think about inflation, it's hard to see how the Fed can turn dovish, because then that would mean that it doesn't care about inflation. And so right now, as we look at interest rates, the overall concern is what is the level of interest rates that we will see in the near future? And I tend to think of it as, if you think about the tabletop mountain in South Africa, it's more like the tabletop mountain rather than the triangular peak, if you will, of the Matterhorn in Switzerland. So we don't expect interest rates to come down anytime soon. And it's not a short-term story. When I think about long-term interest rates, there are a lot of things going on. Look at the yield on the treasuries right now. I mean, just look at the yield on the 2-year treasuries, 3.8% in May, 5.0% today. You look at the 10-year treasury, it's, tops 4.7% this week. So definitely there's a reflection of rising expectations for interest rates. When you look at the long-term budget deficit for the US, I mean, the Fed's QT program, you look at how China is recycling fewer dollars, out of treasuries. Overall, the budget deficit represents 6% of GDP and requires more treasury issuance. So if you look at the need for dollars, if the federal government keeps on borrowing, the rest of the economy gets less dollars to consume. And that typically ends up raising interest rates in the long term. So overall, I think the spike in rates is having a very negative impact on consumers and firms. And the risks of a hard landing, I believe, are intensifying.
Well, that's just a ray of sunshine. Thanks, Rizwan. I don't think you're saying anything people don't generally know. It's good to hear some of those details, but I think we're all in general agreement that that's the likely process. Whether it's shorter or longer is going to depend on a lot of factors, but I think that's a good insight. Bill, let's pivot that to the follow-on to that, which is, and I know this is an area near and dear to your current heart, availability of debt, interest rates, issues with spreads, and generally the lending market. What insights can you share with us?
Well, I think it's following along on that. I think you've got a lot of things going on. Obviously, the volatility in the market has generally widened spreads. So you've got a double whammy for borrowers, which is the index is gone up dramatically, but not just the index, but then the spreads have widened. And that's largely because there's a shortage of credit. So those providers of credit can be choosy. They can put pricing on that they want to be comfortable with. A big group of the people that you saw in this space would have been, not just the debt funds, but also the regional banks being very active in commercial real estate lending. They're just not active at all. They're completely out of the market for the most part. I mean, I'm not saying there's no regional bank making real estate credit, but I will tell you that many of them are under, extreme pressure in groups that we're doing business with that previously were part of the capital stack for various opportunities, really aren't a participant today. And not only they're not a participant, but on, credit that's outstanding, we're seeing them take an increasingly aggressive stance with an array of their borrowers, looking for pay downs. Normal extensions that might occur aren't happening, at the level that they generally would. And then, I don't want to jump ahead, but I know there was a question that had come up about office, and I'm not going to try to answer that whole question, but trying to borrow money on an office building today is I won't say impossible, but it's in the virtual impossibility because people just don't know what the buildings are worth. If people are in them, even if they're in them, it's hard to know what they're going to be worth. I mean, we have two buildings that we're in the middle of. We're trying to refinance. Went to loan committee yesterday, in fact, and we've got Appfolio and Google as tenants on 10-year leases on office buildings in markets that are 95% leased with about a 1.7 or a 1.8 debt coverage ratio. That's a loan that should get done. Maybe it's done at a wide spread. That lender went to committee and said, given the volatility, we love the deal, but given the volatility in the rest of our portfolio, we're going to decline. That's kind of unusual that would have even gone to committee, and that's kind of a real-time changing market because they wouldn't have gone to committee. So I think that we're still into some challenges here. I do still think there's an opportunity, not to directly contradict, but I do think there's still a chance for soft landing, but it's feeling harder and harder in some parts. I mean, look, we're in one of the most impacted industries for financing, real estate. I mean, technology's only marginally in it because they don't borrow a lot of money. So, and when they do, they've been able to do it, at long-term financing, and many of them were smart enough to go do pretty major borrowings before the rates went up. And so I think we're certainly into some interesting times. I mean, I think it's been kind of remarkable how much the 10-year treasuries run, in the last 30 days.
30 days, yeah.
I mean, it's kind of, that's given you a view of where people think. Now, I would say, one thing, the forward curve is seldom right. And so, I think we'll see a break in rates. I just don't think it's anytime soon. I think it feels like we're pretty close. Maybe we got one more move, but I'm not sure we have one more move for the Fed. I just think they have to keep that bullet in the chamber. And so, because as soon as they say we're done, then they got to deal with the pressure of when are we going the other way. And so I think Powell needs to probably hold the line, or will hold the line. I think one of the biggest questions the Fed's going to have is, is this 2% target a rational target? Or should it be something? Should it be 2.5? Should it be 3? I think that's just a made up number. It's just a target, and it's not necessarily correct given the world that we live in today. So.
Well, thanks, Bill. Now we've had number 2 of the super sunshine responses, but I think these are all. I mean, these are the realities of today. I'm talking to a lot of broker dealers and other people in the industry, and there seems to be 2 sides to this coin. There's the people who are pretending everything is just all right. I can't tell you how many people said to me, I'm not hearing that from other sponsors. Other sponsors say everything's great, or things seem to be pretty good, or they're getting financing. And I'm like, well, I'm not really sure you're getting the full story, because it isn't just the people on this call, and it is literally you just have to look at anybody who publicly communicates, who has a responsibility to provide public information, and you can see all of them are dealing with this problem, and a lot of the privates are not.
Look, Daniel, it's clear. I mean, you can talk to anybody, you can look at any of the commercial brokerage firms. Transaction volume's down 70% this year.
Yeah.
That doesn't mean there won't be opportunities for somebody like David or ourselves or others, but it's down 70%. That's impacting everybody. The fact that we're transacting on several things right now kind of feels pretty remarkable. We're quite happy with the few things we've been able to transact on, both the sell side and the buy side. But we set out with in January, a pretty aggressive plan to put out some money, and that money's just not going out. The institutional money is they've got the capital, but they're not pulling the trigger. And in fact, they can make equity type yields off of putting out mezzanine financing. So why would they want to go? They can make 15 to 20 in a mezzanine deal with mostly current pay. So why would they go put out, risk capital? They will ultimately do it, and there are people doing it, but it's just it's hard for people to have courage in these times, and particularly if you're you're a fund manager or or an acquisitions person for one of the PE shops. It's not feeling like a time for courage for them. So by the way, when it doesn't feel like a time for courage is probably when we should have courage to put capital out. But that's generally, been my experience of the last 40 plus years, 45 years of doing this is, that's why we love the space we're in, because we can still pull capital when we need to.
Bill, I'm going to pivot that question to David, because I think you just kind of hit on the next kind of direction for this, which is, where are the opportunities? So David, in what you do, where are you seeing opportunities from the credit tightening, from the slowdown in the market, from the difficulty in selling, and various impacts of all kinds of things, including regional bank issues and others.
So I think what Bill and Rizwan just sort of touched on covered a lot. You know, in March of last year, Fed funds was 3.25. It's 8.5 today, so that's a 525 basis point move, if I have my numbers right. So I don't think really many people anticipated how quickly that rate rise would occur. And I think it left a lot of people unhedged. So, and unhedged meaning a lot of real estate people that didn't lock up long-term paper, that were either in transitional issues, I mean, with properties, or for whatever reason, didn't take down long-term debt. You know, we're involved in a lot of different places throughout the country, Canada and Europe, and with a lot of different kinds of asset classes. And one thing for sure is that I don't think that assets have been properly marked yet. So, you know, what's really happened is you have a gap between the buyer and the seller, and it's a substantial gap. So you know, there are always opportunities, but I would tell you that right now, and this is coming from a lifelong real estate investor and someone who's been trained sort of to own real estate equity and operate property, that I don't see the pricing adjusted yet on the equity side to own long-term equity in the real estate side of it as really attractive. Now, you know, things in the real estate business happen a lot longer. It's like a slow drip, whereas in the stock market, things are immediate. You know, usually the stock market will over penalize very quickly and then run up quickly. And so what you're seeing really now is slow drips of deals dropping that are situational. And they're situational because typically it has something to do with either the particular property or the owner, the sponsor, whoever it might be, the borrower, that has to resize because when they're refinancing, their loan is up. The rates are entirely different, chewing up entirely different amounts of cash flow. And the underwriting standards that the banks, if they're willing to lend, and to Bill's point, it's an if, because I think that's one of the questions right now is who's really actually lending. And someone's saying they're lending, but actually lending at a competitive rate where you can actually buy something of interest. You know, it's not exactly the same thing. And so even someone strong like us or other stronger players that have deep debt relationships, it's just a pricing function. And so the prices haven't reset in my mind. And so, you know, transaction volume is down 50 to 80%. And so I think in the meantime, the opportunities are probably like in short-term debt or mid-range debt, where, you know, you're seeing nice yields, and more importantly, you have sort of like the optionality to stay short-term and wait for the repricing to occur. So if I go through the different asset classes in terms of where the opportunities are, they just haven't really repriced yet. You know, everyone thinks of multifamily as the ultra safe asset. And of course, from a rental demand point of view, that's likely true always, or in many cases, in many parts of the country. But it's a question of where is it priced? And because it was priced very, very competitively in the early years, let's say going back 3, 4, 5 years ago, when that stuff rolls, the question is, you know, price and where can you enter it and buy it? And so that's a big dynamic. Obviously, you know, Bill touched on office. I mean, the remote office function combination of interest rates and when a asset class goes out of favor, not a good combo. So the office building market is challenged, and I'm not sure that the lenders have really dealt with that pain yet. And so you're seeing it come up when people actually need to deal with it. But I think a lot of those loans will have to be resized, and that'll mean to the developer that they'll have to add more capital or increase guarantees and other things that they weren't expecting. Industrial seems to be holding across the country. You know, I guess the question of industrial, so much of it was developed in the last few years. So I guess it's a sort of forward-looking demand issue. But I would say that's safe. Student housing the run up of just the cost of school, of actually sending your kid to school, is become prohibitive for many. And so that in theory would affect student housing, and the same sort of issue relates to the debt rolls. And then retail, there's something other going on, which is obviously a number of years ago with the obviously the e-commerce effect. Now you have the crime effect. So you have a number of retailers actually that are rethinking certain stores. And so you put all these things together, and I think that there will be a market reset. And I think that's healthy for the real estate business to clear and reset, but we're not seeing it yet. So I think in the meantime, it's make sure you have powder and wait for it.
Well, in light of that conversation, and I know we're still currently kind of on one side of this discussion, but I think it's going to build to something. We've talked about inflation and variables in certain asset classes, but one of the things that hasn't been talked hardly at all about, I haven't heard anybody discussing it until we had our prep call the other day, was challenges on resources and expenses that relate to these properties. And specifically, I think it was you, David, who brought up the issue of challenges with insurance, property and casual and other things. So between you and Bill, how are things like the availability of insurance or the cost of certain resources or vendors affecting real estate in other ways right now?
Well, yeah, I always sort of feel like people are forgetting about the operating expenses to actually run a property. Now, inflation historically is like not a terrible thing for the real estate business in the sense that rents typically grow faster than expenses. In this instance, though, it's a little bit different because think about your biggest expense is mortgage expense or your interest expense. So we all know, we all just spoke about that at length. So that has had a huge run up. And you have on the expense side, the general inflation that's occurred on the cost of operating properties, whether it's labor and other sort of operating like expenses. And then you have insurance. And in certain parts of the country, the insurance business right now is going through a major, major problem. And it creates a situation where not only has it gone up in terms of the premiums and the cost, but whether you can get it and whether you can meet the insurance criteria, the requirements that the bank is basically telling you you need to buy a property. So, if you had a, $80 million industrial facility in Florida in a certain sort of, let's say, sensitively coastal area, a bank to finance that may put full replacement value on that, meaning go out and get the replacement value, whereas you can't actually get it from the insurance company. And so that creates huge gaps in what deductibles might be, whether you can get the insurance, then get the lender. So you have sort of different things happening. So I think it's not only cost, it's availability. And I think the market is sort of, that's another thing that's happening. It's particularly happening in very sensitive areas, obviously California, coastal places in Florida, the Carolinas, other places. But I think it's just floating its way through the market. And it's another shoe to drop that's, hasn't been fully baked into the underwriting yet, in my opinion.
Well, I think you've seen the multifamily. I mean, you've seen $1,000 a unit increases in insurance cost. So think about that, particularly if you're in a more price sensitive market, if you're in a luxury product, $1,000 a unit, you can offset that with rental increases. If you've got a $3,000 rental and you get a 3% increase, you got your $90, you're staying even. But if you got a $1,000 rental, that's harder to make up. Now you got to have an 8% increase to 8 or 9% increase to offset just the insurance. So, you've got this pressure on, cap rates accelerating and then costs accelerating at the same time. Forget interest even for a moment. But insurance has probably been one of the big ones. I think it's also just getting qualified people now, and pay's going up. But there's certainly a dearth of people really qualified to manage, an A-class apartment building, given the growth that we had in the business. You tried to move people up the ladder, who had historically managed, a lesser quality asset, let's say. And the clientele's different. If you're talking about a true A, a super luxury, much like the project you guys have, Daniel, in LA, that's a different clientele, because that's a renter by choice. Those people, your residents paying what, $6-7 a foot, can afford to go, more now. So I mean, at our property in Newport Beach, we're getting $4.50 to $5. Those are people that could go buy a house. Maybe they could have 2 years ago. Now it's getting more complicated. Although the home building business is very good. I mean, that's the one part of our business that's been remarkable. I mean, we sold a site last week to a home builder. We've got another one closing this Friday. The home builders are relatively bullish. They're cautious but bullish. They're still buying. They're buying good quality assets. It's got us rethinking sites where we were doing a lot of multi, and we might take some more of those sites to for sale product, because but it's hard. You can't always predict the future. I mean, I'm doing an entitlement, and I'm planning on 5 years from now, not today, because by the time we entitle something and then deliver it to a builder, they build it, it's 5 years out. So you can't try to chase everything at one time. But look, I think hopefully we'll see it moderate. We saw the state of California step in recently on home insurance to provide some relief to the insurance companies so that they wouldn't leave the state, because a couple of them had threatened to leave. And so hopefully that'll stabilize, but it's been bumpy.
It is. I can tell you, as a property owner, just directly, I sat yesterday at lunch with a guy who owns maybe 20 buildings in LA, a person I've known a long time. And it isn't just insurance, it's everything. It's utilities, it's his gardeners, it's every single part of his business. Expenses have gone up on every single part. He's pushing rents where he can, but right now, I think we're starting to see a plateau in rent and a plateau in occupancy. And in some cases, I'm starting to see a decrease around. And I think it's going to be a challenge. So I'm going to pivot here to Chet. Chet, I know you've sat there quietly and peacefully through this first part. I know we're going to get to the sunshine here at some point. Let's talk from the broker-dealer perspective. Insurance. How are you feeling about this and a lot of the issues we talked about? And what do you think sponsors should be doing to better work with broker-dealers and RIAs to communicate this and help manage this process?
Well, as a broker-dealer, we're big believers in doing business with people, not so much a product or an entity. But with that said, we're kind of designed to protect that retail investor, to show them these offerings through our advisors. So we try to do our best, our deepest dive on the background of who the players are at the sponsor, what they're doing, what the offer looks like, how the markets are changing. But obviously we care, to protect us against an attack, catastrophic event, or something goes wrong. But the problem with that is the carrier, the number of carriers out there have shrunk. They've gotten tighter. They're not offering the same kind of coverage. The expenses have gone up dramatically. The deductibles have gone up as well. So unless you have a very strong due diligence, and you've done the due diligence on the persons and the players at those sponsors, the coverage is getting worse. I mean, we had a situation years ago where a couple different sponsors that went upside down, and the carriers get very granular, saying, well, we're not going to cover based on this. So my advice to every broker dealer is to make sure your due diligence is strong. The players that you're doing business with. So the carriers are shrinking, more and more going away, and the premiums are going up dramatically.
Yeah, I hear that across the board. It's getting harder and harder for firms to do business, for the advisors to do business. Obviously, getting harder for the sponsors to do business. That's creating a storm that I think is not being adequately discussed in this industry. I mean, we go to
advisors pay for the premium of their E&O coverage, but when you have to go to them and say, okay, this isn't covered, there's a carve out for this, it makes it a very difficult conversation with you and that advisor and their clients. And you got the plaintiffs attorneys out there that are just churning the waters, saying, oh, they have E&O, they'll protect you, but it doesn't go as far as they lead the clients to believe, nor they tell the clients, oh, your advisor won't be named at all. But yet, as we know how the rules read, if whatever advisor was attached to that issue is going to get pulled into it. So as a broker dealer, you look for other avenues and other areas of protection. Advisors sometimes themselves will go out and get their own coverage, but it's just the space is shrinking, so it's harder to get protection. So the onus is on us to do our deepest dive as we can of the sponsors and see how the markets are fluctuating, work with the sponsor and what's going on there, and make sure that we stay in touch with each other.
Well, and I think that that's an important part of it too. I'd like to see our industry associations dig deeper into these issues, and I mean, between IPA and NADISA, just having looked at those two conferences by themselves recently, I don't think there's enough discussion about any of this stuff. It's all
ironically, I had a conversation. Have you heard of Independent Broker Dealer Consortium? It's an E&O kind of based entity that's run by Lillian Morvay, and she's a former attorney. She's also a former underwriter. So there's a group of different broker dealers trying to get together, figure out what's the best solution internally for us with the carriers, as well as what can we expect or ask of the sponsors to kind of make a balance there. So there's no good answer yet. We're still kind of exploring it. So that's one thing that we struggle with is what kind of protections can we put in place to make sure that we're all on the same page?
Well, I think the more of that, the better. Rizwan, I'm going to pivot to you here. So let's talk about distress and dislocation. I think that there is this perception that there's currently a lot of opportunity in distress and dislocation. I don't think that that's actually true yet, but you'll tell us what you think. But more importantly, where will it maybe come from? So opposed to what may be here today, where is it going to come from? Where are you seeing and talking to a variety of sponsors and looking at the industry, this kind of opportunity? And how do you as an RIA identify sponsors or managers who can best do this? Because everybody's saying they've got a distressed fund now, and they're going to do it. If everybody who has a distressed fund bought all the distress, there would be, I mean, there's probably 5% of the distressed product for the amount of fund money that's theoretically out there. So how are you identifying managers, and where are you seeing the opportunity?
What does he need managers for? He has Bill and I.
Yeah, so if you think about the last time we talked about distress and dislocation, it was at the beginning of the pandemic, and it never came. So this time around, we are a little more optimistic. I think that it might come around, just given the uncontrollable aspects of interest rates and cost runs and so forth. But the way I think about it is that there is, the cracks are starting to appear. I think they're probably going to appear in different asset classes across geographies and types. And it seems like there is a wall of maturity if you look at the CRE debt, and that's going to come down over the next few years. The question is, it's going to be distress and dislocation if you cannot find a capital solution to actually solve the problem. And so I think that's the key word, which is capital solution. Can you actually come up with a solution to the problem that has occurred? And to be fair, I mean, who could have anticipated a 5% interest rate rise over the last year? I mean, that is just not our lived experience. We have never experienced anything like that. So at this point, I think what we are looking for are people who understand kind of the markets, the different asset types. We tend to invest with focused, specialized managers who do something really well. And so what we are looking for is managers like Time Equities and Shopoff, where we're trying to figure out where we should invest our incremental dollar of real estate. And what's important to us is that we place that dollar with managers who have been, if you will, around the merry-go-round a few times. I mean, they have the perspective of inflation, they have perspective of rising and low interest rates, market cycles, and so forth. But to me, it's really about, can you source those opportunities? Because yes, the markets are going to happen, but can you really source those opportunities as a manager? And then can you prove to us that you have the skill set to actually do the right thing? You have the capital solution, you can actually operate and maintain the asset and give us the income and growth that we expect over time. So to me, I think this is the time where the proverbial men, separating the men from the boys, starts to come into play. And we are very cognizant of the experience base that managers have. And we are trying to stay away from people who had a very successful business leveraging very low rates and high leverage. So to me, it's all about experience and sourcing at this point. And we are looking forward to participating in that. But again, I don't think that the cracks today are necessarily justifying that we should put a lot of dollars in today. I think it's going to happen over time, and we can be patient. Because I think at this point, it may be an opportunity for vintage investing in real estate, and we all know real estate is a long game. So that's how I would think about it at this point.
I appreciate that. Chet, do you have anything you want to add to that?
Nothing that I could add to.
What about Bill or David? Because I think this is an important concept here.
I was going to say, I think the opportunity in the next year or two, because of sort of the way the debt is coming out to us, is going to be structured around the debt, meaning debt discounts, buying debt back cheaply. Sadly, I think a number of the banks are going to take large loan hits. I think sponsors and developers who overpaid for properties or for whatever reason couldn't get the property where it needed to be in a stabilized way are going to take hits. And I think a new buyer can come in and maybe use, the participating debt feature. I mean, we are traditionally long-term equity players. We buy properties and hold them really for long, extended periods of time. For cash flow and upside, but I think there might be a way to use capital in a way where you can come in a first position or even a second position if the numbers are right, and then have some participation in the equity, and that might be a way to sort of enter the game with some downside protection, but with some upside potential on sort of a resetting of the value. So that's what I would hope will occur, I guess, the way I'm looking at it.
Bill, do you have anything to add here about distress or dislocation?
Yeah, look, I think there's a lot of theory that it's going to come. There's a massive amount of capital, waiting. I do think you're going to see some. I mean, I think that the banks are going to have to, unless we get rate relief, they've got to mark their portfolio at some point. If I were to look, kind of across the board, I don't think the banks have a lot of exposure, a lot of risk in their industrial, their multifamily debt for the most part, or even their retail for the most part. Underwriting standards were pretty good. I think equity may be at risk, but I don't see a huge distress at the banking level. As I talked about earlier, I do see it in the office market. We're seeing office trades. I mean, we just saw a loan trade for 50 cents on the dollar, and candidly, I'm not sure whether that's a good deal or a bad deal. I can't tell from here. There's just not enough data. I'm looking at occupancy, physical occupancy versus leased occupancy. Ultimately, leased occupancy starts to move towards physical occupancy. That if you're 90% leased, but you're only 50% occupied, those tenants do ultimately reduce the amount of their footprint over time. And I just don't see it going back to where we were in 2019 pre-COVID. It seems complicated. Although our business, we've stayed in the office, we're in the office, we've mostly got people back, but I don't see it with a lot of firms. And it depends on your kind of business. I mean, I have friends who have very successfully migrated to a mostly out of the office. I've got one friend of mine who, went from 25,000 feet to 5,000 feet and has, his employees who work in teams, and, team one comes in on Monday and team two comes in on Tuesday. And, he's been able to make that work successfully, and his revenues are up and his cost is down. That's, I think, going to be an impact to, the lender universe. But as I said, I believe there is so much capital amassed that once people start feeling like there's a place to jump in, I think it'll support pricing maybe at a level that's above true distress and be more opportunistic. And I know those are kind of fine points, but we're still seeing capital. I mean, I'm in the midst of a discussion on a sale of an asset that's not even on the market, and I've got inquiries and offers that are candidly quite good. So I think you have to kind of just wait and see, pick and choose. And I think you've got to differentiate in the distress world between a distressed asset, because it's just not very good asset, in a distressed entry point on pricing. I have bought things really cheap in my career, and sometimes cheap is not cheap enough. I mean, I bought an office building early in my career for $2 a square foot, and we sold it for $5, and so we made money. But there was a lot of work between 2 and 5 that you were like, how can it be this hard to sell something and not make money at $2 a square foot? Well, sometimes you just, you got to evaluate your options a little bit better. Yep. So I think it'll be time to be thoughtful, be cautious. I think we are, as I said, a very interest rate sensitive business, even though there's some that would like to think not. If you chased yield through IO, low rate debt, and you didn't lock it long enough, you're going to be challenged if you bought a super low cap rate deal and you were making spread just on buying cheap money, because I think that'll be complicated for people. I think some of the triple net business that was done at very aggressive pricing going to be hard, because even if you get rent bumps every 5 years, your rent bump doesn't offset even close to the increase in your debt cost. And so you're either going to have to bring capital to the deal when it comes time to refinance, or you're not going to be able to do that. I mean, if you had 4% money, which is now 8% money, let's say, or 7% money, your 5%, your 15% rent jump or 10% rent jump after 5 years doesn't catch you there. So I think we'll just have to wait and see. I've been doing this for a long time, as you know, Daniel. Been in the business for 45 years. I actually have seen rates go up this quickly. We're still at a rate that's below the median of my career. I mean, think about that. You youngsters, David, he's seen the world only on the downward trajectory.
But I hear it from Francis and Bob all the time, though. I hear the 18-19% prime rate. So
yeah, that's when I got into the industry. So
but even 18 or 19%, when I started Marcus and Millichap in 1989, and through the early and mid 1990s, rates were 7 and 8%. That was very normal. And I don't think it's going to take rates being 3 or 4% for the business to get restarted. I think when rates stabilize and there's a sense of some sort of continuity, that there isn't a question of how much are they going to change, how much are, and on both sides of the coin, not just the inflation and interest rate side, but the expense side. When a bank can figure out and buyers can figure out where stabilization is, I think things will start to get fluid again. There's a big body of evidence that buying something with a 7% interest rate is a better bet over the long run than buying something at a 3% interest rate, assuming prices have adjusted, because you've got, the rates could go down, but when you're buying at cheap interest, all they can do is go up. So we'll see where that all lands.
But I think, like one of the questions that popped up, I happen to I tend to agree. I think our federal, it's not just the U.S. federal budget. It's across the globe. I don't believe that these countries can afford to keep rates as high as they are and not adversely impact their budgeting process. So I do think you'll see political pressure to bring rates down. Look, there's so little discretionary spend in the budget today, in the federal budget. And yes, there's this desire to spend less someplace and other places, but interest is starting to crowd out any sort of discretionary spending.
Yeah.
And look, it's pretty simple. You want to get reelected to the House of Representatives every 2 years, you got to bring home the pork. And if you're fighting against a budget that's being completely consumed by higher interest costs, so I do think you'll see some, in my view, is you will see some downward pressure. Do I think we're going to see a 155 10-year again, in the near term? No. But do I think you could see a 3 to 350 treasury, sometime in the future? Yes, I do. But it'll take some time. It's not going to be tomorrow. But I do think, look, rates are going to change differently than whatever the forecasts are. They will either change faster or slower, but they guaranteed will not change per the forecast, because that's just not how the world works. This is like, if you looked at the Fed curve, the Fed's forecast of their curve, a year and a half ago, it didn't have this in it. And, in my opinion, they started too late, moved too fast, moved too high. If they'd started earlier, they wouldn't have had to move this high. But they are what they are. They're gonna do what they think they're gonna do for the right cause, even if it may or may not be. So.
I'll tell you what, one thing that we talked about on our prep call, I'm hoping that there's a solution to this, but at some point they need to make sure that the regional and community banks are shored up also, because they provide so much capital to the local businesses, the local communities in the country that people need. And to the extent that they're not competitive lenders or a viable source for the local people throughout, and this extends beyond real estate, I think that creates a different issue. But I share Bill's point of view on the rate dynamic.
Well, it sounds like that, Bill, you've added to the Fed's mandate. I mean, it used to be inflation and employment. Now they have to look at the federal deficit, the budget deficit, to actually set rates. That's going to be interesting. Yeah. Because, I mean, if there's going to be political pressure from Congress, then they have to react to that somehow. But that's, that goes the independence aspect of the Fed.
And on the real estate side, I think
the theoretical independence of the Fed.
Yes, theoretical independence.
Sorry, I'm a skeptic of that level of independence, but I think that we will find some stability. I agree with David on this regional bank. Look, the majority of job creation in the United States happens in small business. It has historically been and continues to be where jobs are created. It's not created in the Fortune 500 companies. It's created in small businesses across the United States. And if those business owners cannot find credit, and look, they have great ideas. It's clear, because I meet these people all the time. You obviously do in your business as well, Rizwan and Chet, because that's the clientele. You guys have lots of accredited investors across your platforms, and those are largely people who've created a business and created wealth for themselves and their family. If that capital doesn't exist for them, no matter how good their idea is, they can't affect a business plan.
Yeah, I think the issue here is that cost of money is again becoming real. And so you have to create a business plan that includes the higher cost of money. I mean, we've been used to very low cost of money for the last 10, 15 years. And I think that's an anomaly. So the question now is, if there is real cost of money for all the reasons that we have discussed, then the investment programs, the business opportunities have to take that into account. And that will differentiate people who truly create organic value versus people who just use cheap money and high leverage to actually create value. So I think that we may be coming back to a world where organic growth based on skill sets and the inherent aspects of what creates value in a business starts to come into play, and not the financial engineering that we've been used to.
And I think that goes, and in the end, and to shift it back towards real estate, which is obviously what Bill and I and Dan mostly focus on. But you actually have to be creative, you have to be innovative, you have to think about how to use space differently, how to create the demand on vacancies and whatnot. And there's certain things that we're discussing internally. I mean, we've expanded into renewable energy as an entirely new business line in the last 5 to 7 years. That's been interesting for us. So trying to sort of not look at something so hard lined because you've maybe done that in the past, and trying to look ahead a little bit on, what might be the path for the best way to surface the value, because that's really all we're all trying to do.
Yeah, I think
there's another aspect that we are observing. If you think about the private equity sector, if you look at small businesses, that's where the growth is in America. A lot of that is financed by private credit today because they cannot qualify for bank lending. And so if real estate is also unable to qualify for bank lending, does private credit come in and provide those capital solutions that I talked about? And maybe we are on the cusp of a different era where the private credit industry comes up with some of these solutions. And maybe, they give you debt, but they earn in warrants and equity returns. I mean, maybe we are at the cusp of seeing things done very differently. And it comes back to, if there's a good real estate situation, you're going to find capital, whether it's debt or equity, to actually solve the problem. And so I think we just need to think about whether the thinking is going to go out of the box here, just given the pressures, the magnitude of the pressures that we are facing in the industry.
Look, like David, we've seen, different opportunities as well. I mean, we're, on an industrial project we're working on right now, we have to put solar on it to appease, some of the project opponents, but they want more solar than even the project can consume. It's created a new opportunity because there's an adjacent business that wants to create a hydrogen fueling station. And, we have the power, we have the power they need by building it on this industrial building. Well, that, may end up with a piece of ownership in that hydrogen fueling station. So it's kind of a very innovative, you have to look at innovative solutions today, right, to create value. And we do see those things out there. I mean, I don't want to, I think, Daniel, we have had maybe a little bit of gloom here, but there are opportunities and we are finding them, but they're not abundant at this point. But, everybody keeps thinking this is going to be, I always hear this is the next RTC. Well, I started in the RTC and there's only going to be one of those in our life, because the government's never going to allow, that kind of transference of wealth again. If you look across the board at many of the big private equity shops today in real estate, they cut their teeth. This is when they founded themselves. They got started in that time period.
Yeah.
And, they look across the board at all these guys who became billionaires who didn't have a billion when they weren't billionaires then. They're like, we're not going to let that happen again.
That was a great opportunity.
It was a great opportunity. And it was a great opportunity for us. And we should have bought more. I mean, it's clear today, but we bought everything we could,
Well, that may be today too.
Yeah. I think you're going to find the opportunities. And when you finally do find a point where you feel comfort and courage, I agree with you, Daniel. If you can make deals work in this interest rate environment, it feels like you have upside, because you have the real estate upside, plus you have the credit market upside. So as I tell my acquisitions team, these guys are, sometimes they get a little glum because they're not getting the deals done this year they want to do. And, some of our other stuff's more work than they'd like to have. And, we're we're marking some stuff, and we're probably going to, not make as much money, and in some cases we're going to lose some money. That's going to happen. And I tell them, but if we're losing money, that means we have an opportunity to double down and improve our position, and our overall portfolio will get stronger, not weaker, as a result of how we're positioned, how Time Equities is positioned. If you're positioned well, yeah, you get whacked. Like there's no way that David or I do not have some marks in our portfolio that we're not happy with, but we have they've got decades longer than we do of staying power. And seeing these markets. So I think that we look at it and say, you know what, it's not all that fun, but out of the not fun comes fun. And that's where I see the market today. So I'm probably a little more upbeat than, if I walk around the office today, there's going to be somebody who's got their teeth kicked in on something that we're doing. And I'm looking at it, I'm like, we're actually having a very good year. We're probably, there's no question, we're going to have our best year ever from a profit standpoint. It won't be our best year from a cash flow standpoint because we had to put a bunch of money back into projects that we weren't expecting. But it's a profitable business year. So
listen, if you own a lot of real estate throughout the country or in other places, there's even you have a network of very interesting businesses that are operating in a building that you own. And I think if you look sometimes within, I think you might see some partnership between sort of the real estate ownership and some combination of some tenants when it's appropriate into their businesses. That could be another way to sort of trade some rent forgiveness if someone needed time or struggle to get stabilized. So I think it's those kinds of creative things that make me feel like, all right, you come at this, think about it differently. And so to try and
let's with the time we have left, which really isn't any, let's pivot to a second for more to the broker dealer side. Chet, I know again you've been quiet back there.
I'll just listen. It's very interesting.
I agree. It is a fascinating time, but talk about regulations a little bit. Right now with the regs adjusting the way they are, the direction that they're going, how do you see that affecting the offerings you're reviewing, how you're dealing with investors, and how you're dealing with your sponsors?
It's definitely making us take a step back and be a little more scrutinizing of the offerings that are being presented to us. We're putting less and less on our shelf, and again, unless we know the players that the sponsor, the people, the principals, but because of Reg BI and other kind of new rules that have come out, it makes us do some second guesses. I think the biggest concern that I have, and that's why I said everything you guys have talked about is extremely informative, and I appreciate it. So I think that's one thing the regulators are lacking. They don't have the proper education. So they make these decisions in a vacuum and say, oh, well, every client should be in this box. We all know that not every client's the same, whether credit or not. So I would try to somehow get, as an industry, us to educate the examiners so they're not coming and making these broad stroke decisions saying these are all wrong investments, these clients are not suitable. Because they're the right investments for the right clients, otherwise we wouldn't have them on their platform. But I think that's the biggest failing right now is the industry, the regulators are lacking the industry knowledge of what you guys are doing. So that then funnels down to us, and we put less offerings on our platform because of the concerns or backgrounds or whatever the case may be, and the regulations, how they're changing. So I would somehow, next time I talk to my FINRA committee, implore them to start getting some more education. Because to them, to FINRA, alternative is a bad word. If it's a stock, it's a bond, mutual fund, they're okay. But alternatives, because of a lack of liquidity or the perceived lack of liquidity, it's a bad decision. It's a bad investment. So I think it's just a matter of educating them. So that then funnels down to us. So then we do our best to educate our advisors, do their best to educate their clients. But again, going back to the E&O coverage, they make this broad stroke decision. Well, no one should have been in that investment because it went sideways. It's just such a bad. You can't run a business that way. So I think the regulations are getting more and more constrained on the firms and the entity and the advisors and the clients. I think it's just a matter of lack of education.
Well, let's do this. It's time to wrap this up. I'm going to ask each one of you to kind of give some final thoughts. You might also want to glance at some of the Q&A and see if there's anything from there that you want to try to answer live as opposed to after the fact. I'll just start with Chet. You have anything you want to conclude with? I know we kind of really focused on what are perceived to be a lot of negative factors. I think it's more a matter of a realistic look at the market today, but maybe you have some insight that you want to share additionally to what you've already said.
No, and I don't see any of the questions coming in, so if there's any specific that I can answer, I have not seen those, but I think this is very informative, and again, I think it's our job as broker dealers as well as advisor reps to educate our clients and what's going on in the market and stay focused on what firms like you are doing to ensure that everyone's up to speed of how the markets are moving.
Thanks, Chet. Rizwan, do you have anything you want to add?
Sure, maybe I'll take the client perspective. I mean, if you think about what clients are concerned about today, it's two things. One, obviously, given all the market volatility and what's happening with interest rates and its impact on real estate, they're concerned about what's happening with their current investments. And so there, I think the challenge is to communicate, first of all, listen and communicate and extract from our managers the key insights that help us tell the clients what exactly is happening. And you know, our policy is to be very transparent, very open. And the idea is that the more data we have, the easier it is for us to communicate actually what's happening in the client portfolios. The other thing is, from a client perspective, is, as I mentioned earlier, that this may be a vintage opportunity in real estate. And so the idea is to figure out where those opportunities are and to be able to communicate to clients how they can invest their incremental dollar in those opportunities. So again, I think the challenge we have as advisors is that sometimes, you know, when you are on the receiving end of a distribution and then it's cut short, it's sometimes challenging to explain the reason behind it, but obviously we understand some of the business pressures. And so the more we can get transparency around what's happening in the assets that we have invested in, and then on the other side, look at opportunities that truly are vintage opportunities. I mean, that's really how we pay for our bread and butter. So.
I just want to answer or hit on one of the questions I saw in the chat just very briefly, which is a large narrative that's going on now about the suburban office buildings being converted into multifamily or residential. Obviously, and I know Bill is also and you, Dan, are looking at this as well. But obviously, when it's feasible and it works, some buildings lay out for it, some locations lay out for it, some don't based on how it's configured. I mean, we're doing it in a number of places across the country, but in some places it doesn't work. And so it's very situational. So that's sort of a one-off thing. I know that's a large narrative that's happening. So I just wanted to sort of hit that because I saw that in the chat. And then I would just sort of end with, I sort of feel like a combination of a real estate executive, a therapist, and a financial advisor in a lot of ways. Meaning, I basically feel that it's my job to go out and to just be available to people and communicate and be a liaison and sort of. So I try and think about people a little bit more wholesomely in terms of where the best circumstance is for them. And I find myself asking more questions about what their objectives are and what their concerns are, and trying to use that in a way to sort of help advise, sort of like in a real estate point of view in terms of what we do, where things that they might consider. And so, I view that it's something that I personally enjoy, but I think that's the positive that will come out of the industry here, is that I think there's more and more people doing that, looking at people wholesomely and not just about a particular product, but more about what the objective is for, a particular client or investor or whatnot.
Thanks, David. Bill, I guess you're last up. Anything to add? Well,
I'm going to address one of the questions was about how does multifamily pricing adjust to the current loan environment. I mean, pricing is going to change. It is changing already. And so, but I think that, we haven't always used positive leverage. There for many times in my career, if you thought rent growth was sufficient, you didn't necessarily have to have, a cap rate higher than a loan rate. I'm not saying that we will or won't, but so I think the adjustment isn't that we went from a 4 cap market to a 7 cap market, for example. Some product we will go there, by the way, because it should have never been a 4 cap. But I think that it'll happen over this course of this time period. And then a little bit is, where do we believe forward rates are going to be, and whether the current market needs to take that full hit to make that happen. Generally, I do see the real estate market. I mean, it's different than the stock market. And it's another question out there. I don't know if it's more resilient or less resilient. I think it's about getting to fair value on both of them. I think the stock market, to me, felt pretty fully valued, and the market's kind of responded with kind of the concerns of the future of earnings. That's where real estate will be. It's about the value of the credit plus the value of the cash flow, and it's usually the sum total of those two things that's going to establish real estate value. So as the credit markets will get better. I don't know whether it's 6 days, 6 months, or 6 years. I think it's probably somewhere longer than the first two and shorter than the third. But we'll be in a better credit environment, and that will support robust real estate investment. So.
Well, thank you to all of our panelists for your insights. I think that was an excellent panel. I got a lot out of it, and I hope that everybody else did as well. We are very appreciative to the large group of people who listened in, and if you're listening to the recording of this, thank you to you as well. If you have anything you need from this group, you have questions, you can contact Shopoff at 8444-SHOPOFF or info@shopoff.com. We'll disseminate any questions you have or get you in touch with anybody you need if you don't know how to reach them. Again, appreciate your time and interest in what we had to talk about, and we look forward to speaking to all of you again soon. Thank you very much.